How's it going, everyone? It's Sam. Today we are talking about the stocks that I feel are getting awfully cheap or have a lot of growth potential in front of them. And there's some really interesting stocks in here. Some of them are dividend stocks, some of them are really high growth stocks, some of them are penny stocks. There are all different kinds of companies in here, and I think a lot of them are getting to very attractive valuations. So I'm going to go through these, and hopefully you guys like them. Let me know your thoughts in the comments below, what stocks you're looking at, because this is a big week for the stock market. I could see some interesting things going on depending on how the elections work out, depending on the pandemic cases, depending on stimulus. There is a lot going on over the next few weeks, and it's causing there to be some really attractive valuations, like I said. So, little spoiler alert too, I will be talking about Workhorse later, but I think it's important before we get into it to remember that any stock is worth looking at if it drops low enough in value. I mean, there's this risk reward that you're looking at with every stock, and if the reward goes really high and the risk comes up but not as much as the reward, then it's definitely worth considering. Any single stock I will gladly buy if it falls low enough and I feel good about it. So these stocks that are coming up are at really interesting numbers and are falling down to a level that I am really interested in. So thank you guys for watching this. If you guys don't mind hitting the like button before we get into it, I really appreciate that. Also, I just got word back from WeBull that they are pushing back the 3 extra stocks. So they were supposed to end yesterday, but they are doing it for a little bit longer, where if you sign up, deposit $100, you can get 3 free stocks. So definitely check that out. It's a really good offer. Also, they're giving you some other offers in app too. So that is something that you should definitely consider doing. It helps out the channel a lot. So let's get into it. So the first stock on this list is AT&T. So this is near a 52-week low. If we look here, $26 a share. It's at 27 right now. It came up a little bit recently, but it is near low levels, near record low levels. If we look just on the 1 year, it was up around $40 a share. And there has been some mismanagement in the company, but with 5G coming out soon, with people getting new 5G phones, with people just having to stay at home a lot longer between HBO Max and between some of their other product lines, I think that this stock could do pretty well. If we look here, their free cash flow is pretty good. So they had a really good Q3 earnings report just last week. And you can see that they have free cash flow of about $26 billion for the year. Now, a lot of people were worried that they weren't going to be able to pay their dividend because it is very high. It's at a dividend yield of about 7.7% right now, which is really high. But you can see here they were expecting it to be about a payout ratio in the 60s, but because of their free cash flow, because of the great quarter that they had, they're looking at more like the high 50s. So they have said that they want to continue to raise this dividend. The management says that. But I think that's going to be interesting because there is so much room to pay that dividend, and because they are looking at possibly selling off some bad parts of their business or just some extra fat in their business, trimming the fat, and they can become a little bit leaner, a little bit meaner, and hopefully even if they get back up to the price that they were at before the pandemic, if they even just get back up to 40, and it takes years for them to do that, you're getting an 8% cash flow, or an 8% dividend, I should say, and you would get about a 50% rate of return. So even if that takes 5 or 10 years, you're still increasing in appreciation about 50% and getting a huge dividend along the way. Now the next stock, and we'll get to some really interesting ones down the line here, so stay through to the end on that. But the next stock is Facebook. They came out and destroyed their earnings report. They reported earnings with a couple other big tech companies like Google, like Amazon, and they also crushed earnings. But you can see that just Friday they were down about 7%, and they are down pretty significantly from some highs that they had, because they were up to about $300 a share, and then they went back down, and then they've come back up and back down a little bit. So they are such an interesting company. They're my favorite holding that I have, and the biggest holding that I have. They're just so solid, right? So they're a massive company, and they are still growing like crazy. Like they were supposed to report about $1.91, but they reported $2.71. Now, the reason that's going down is because they actually decreased their numbers in, I believe, the US and Canada with their active users. So a lot of people were worried about that, but they are a major part of the economy here, a major part of our daily lives between Facebook and Instagram. And outside of the US, a lot of people use WhatsApp. They have been able to pick up some of these companies very cheaply, like Instagram for $1 billion. They have grown it to be such an important part of our culture and our lives, especially younger people's lives using Instagram. And they're supposed to grow about 25% over the next year. Their revenue is supposed to grow 25%. They have very strong margins too, in the mid to high 30s, even low 40s. So it's going to be interesting. I think there aren't a lot of other companies that are this size that trade this cheaply for their price to earnings ratio. So I think that they are going to be a great company to hold on to. And if they get a lot cheaper, if they get much cheaper, I'm probably going to have to pick up more shares because it's so attractive. It's such a quality company, and they just produce so much. So I think that they're going to be another company that I'm going to have to buy into because it is trading pretty cheap. And if it gets even lower, I'm going to definitely want to pick up more of it. So it's hard to buy it after I bought it at $150 a share, but I think it's still a great company to buy right now, and especially if it drops a little bit lower. The next company that I am looking at is Planet 13, or PLNHF. So this is a penny stock that I've been buying since it was mid $1, and I've been buying along the way up. You can see it has some high highs and some lower lows. It's a pretty volatile stock. It is a penny stock after all, but they hold the largest dispensary in the world, and it's 112,000 square feet. They're looking to expand their main dispensary. They have a secondary dispensary and location now. They're looking to expand to California soon and expand about 5 to 10 more locations over the next 5 to 10 years. The reason that this stock is really interesting to me right now specifically is the election. So if Biden becomes president, you can see here that they actually want to decriminalize what they're doing here. So I want to be careful about what words I say just because YouTube does kind of look through this to make sure it can be monetized. But they're looking at making sure that this is decriminalized, so that will make it a lot easier for this company to expand and grow, maybe increase their locations. And it's going to be really interesting to see how it does just in the short term if they start decriminalizing this and make it a little bit more available to the masses. So that will be really interesting to see. And every time that Planet 13 comes out with news, it's typically good news, whether they are diluting their shares a little bit to gain some capital to expand, or they come out with really good earnings. I think that they are a really good company, and I think they have a huge earnings potential and a huge expansion potential with this company. So that is one to take a look at in case you want to get into that industry. The next company is Store Capital. So Store Capital is a REIT that I really like. I've been expanding my holdings with them. I've been expanding how many shares I have of theirs. And it's a really interesting company because they focus on non-investment grade tenants. So they're not going after the Home Depots, they're going after the Ashley Furnitures. So you might not really understand why that's a good thing at first, but they are able to charge higher rents because these companies aren't as established. They can get more information out of these companies. So something like a Home Depot, like a Starbucks, they won't give the actual earnings from a specific location. They don't want to do that. They hold a lot of power because of their brand, right? So they won't give the information on a specific location before renting it out. But smaller companies like Ashley Furniture or some of the other stores that Store Capital actually works with, some of the other companies, they will actually show what they make at a specific location. That way they can actually see if the individual branch is profitable. So that way they are not screwed out of a location, or that way the company doesn't go right under Store Capital's nose. So they're able to get higher rents and be a little bit more secure with the companies that they rent to. They are pretty attractive right now. They have about $700 million in cash, another $200 million in receivables, and they have pretty much no long-term debt that's due right now. And they're Even their accrued expenses and their current liabilities is under 200 million, which isn't that much. If we compare that to something like Realty Income, which is a fan favorite, we can see here cash and cash equivalents of 35 million, accounts receivable 255, so altogether about 290. If we go down to their current liabilities, about 70 million, but accounts payable 21, accrued expenses and other current liabilities about 180. So you can see the ratio here is a lot worse. For example, their cash and cash equivalents, accounts receivable, all that is about a 1-to-1 compared to store capital. This here is about a 3-to-1 ratio as opposed to a 1-to-1 ratio for store capital. Also, if we look at their book value per share, that's about 18.5 and their price is about 25. So even just rough numbers, let's say that their price to book is about 1.3 or so compared to Realty Income. They are at almost $58 a share, and their book value down here you can see is about $30. So price to book is about 2. So a little bit better there too. And if we look at their dividend here, it is a very attractive dividend of about 5.6%. They've grown it pretty well over 5 years. If we just look at their dividend history here, they are consistently growing it, a couple cents every quarter. So each year they bump it up a couple cents. So that is a company that I'm really looking at. I am probably going to buy them no matter what, but if they go down any more, then I'm definitely going to pick them up. They also announced their third quarter earnings this Thursday, so definitely be on the lookout for that. Now, I have 2 companies left. One is Disney. So Disney, I think, is really interesting because whether we go through another shutdown here in the US or whether we open up, I think it's going to be good for them either way. So Disney is focusing on their streaming service. They've announced this recently that they're going to put a lot of effort into their streaming service. Now, whether that means that they are cutting the dividend and going to put that all into putting a larger budget towards their streaming service, I don't know yet. They haven't come out and said that they're going to cut the dividend long term, but if they focus on their streaming more, I think that's going to be good for them long term. There is a lot of potential there. They've been able to grow a lot of subscribers, but they don't have a lot of content, a lot of new content on the platform. They have a much lower budget right now than Netflix, than even Hulu or Amazon. So I think they need to put more money towards that. But let's say we go through another shutdown and they start putting more money towards their budget. More people will pick up Disney Plus. Let's say we open up though, then we are going to be able to get their parks back working. They're going to make more money there. So either way, there's a way that you can kind of think about it as being a good thing. So I think that Disney is very attractive, and a lot of people are still cautious about it because they have their park shut down. They are looking at changing up what they're doing. So a lot of people aren't thinking of them as a streaming service yet, and they sell for much lower multiples than something like Netflix. So that is something that's really interesting to me. The last company on this list is Workhorse. So as you may know, I talk about Workhorse a lot. I think that they have a lot of potential. They are very speculative, but the reason that they've been down so much since about mid-September is just because we haven't heard about the USPS contract. We've had some short sellers come out and say that they are shorting the stock, but the stock is down about 50% from their highs, and we haven't really heard anything bad from the company. It's not like anything bad has happened. It's just that they haven't gotten the contract yet because USPS has pushed this back. So even if they get a small portion of the contract, even if they just go back up to the highs that they were at before, just about a month and a half ago, they would be up about 100%. So this is a very attractive company, especially as it falls farther and further down. Now, it is highly speculative. It is a company that will go up massively if they get the USPS contract, I believe. And if they don't get it, then they'll fall down pretty quickly, pretty drastically. As you can see, we're already down to $15 a share, and we haven't gotten any bad news. However, I think that they have a very good chance of getting a large portion of this $6 billion plus contract because of the fact that they're the only EV stock or the only EV competitor in the race right now. A lot of the other companies are hybrids. And the USPS wants to save money long term. They want to be able to lower the cost of maintenance of delivering packages. So this is a really interesting company to go with then. And even if they only get part of the contract, I think the stock price will go up. So thank you guys so much for watching. Let me know what stocks you're buying or what stocks you're looking at over the coming weeks as they get more attractive. Again, like I said at the beginning, any stock is attractive if it falls low enough. There's always a risk reward. And if the reward goes higher, even if the risk goes higher, but it's a lower risk compared to the reward, then it's definitely worth considering. So thank you guys so much. Thank you for checking out WeBull. Thank you for hitting the like button. And I will see you guys in the next video. Bye.